Good morning, everyone. Thank you very much for joining me. This is the morning market review with myself, Russell Shaw. I'm a senior market specialist at FXCM, and my email address rshore@fxcm.com. Today is Tuesday, it's the 25th of April. Just going to bring up our disclaimers. We'll put up the high risk investment warning first. I'll keep this on screen for a few moments. Can I just double check that you guys can see the screen? Can you guys hear me? And can you see me? Okay, excellent. Thanks, guys. Thank you very much. All right, let's bring up the commentaries disclaimer. I'll keep this on screen for a few moments as well. All right, and just the references, market scope and trading view. We're going to start off actually with market scope. I'll come to trading view in a moment. Carrying on the theme that we've been dealing with over the last week or so is just the lack of volatility in the Forex market. That continues, and I think that the market is waiting for a catalyst, which can either be US GDP Thursday, core PCE on Friday. The GDP is coming down. I think the forecast is 2%, and the core PCE month on month is 0.3%. If we hit that, we're going to get 25 basis points. That's, I think, discounted already into the price. So if that's already discounted into the price, barring any surprises, we're kind of seeing this drift. And what I've done here is I'm looking at the zones, but I'm looking at the zones on a weekly basis. And you can see the momentum is really narrow. You've got the Bollinger starting to squeeze, and the candlesticks are drifting in zone 2. That's between the two blue bands, which is effectively our neutral area. But what's interesting is when you take a look at the RSI on the weekly chart, the RSI on the weekly chart is sub 50, it's under 50. And anything below 50 is on the bearish side of the oscillator. Anything above 50 is on the bullish side of the oscillator. And you can see that the momentum here is certainly hinting to a potential breakdown. In other words, Bollinger theory says that markets cannot stay at rest indefinitely. A squeeze in the Bollinger Bands would tend to lead to an expansion in volatility. And whilst it's very difficult to get a directional directional clue from the Bollingers themselves, when you throw in an oscillator, it helps. So potentially a movement down into zone 3. Zone 3 is our bearish area. That's between the lower blue and the lower red. And that's because the indicator is on the bearish side of 50. Now, can we back that up fundamentally? And that's where we'll bring in trading view. And what I have here is the US GDP year on year. And what I've got here is the US core PCE. And I think there is a few takeaways here. First of all, you can see that GDP is coming down. You can see that core PCE is coming down. But for me, I think the real interesting part is the rate of change. So we put on a rate of change. This is a 12-period rate of change, and it is decelerating. So it's showing a slowdown, deceleration in GDP. Okay, let's take a look at core PCE. It's showing deceleration. Now, as long as we maintain the decelerations, well, the Fed's going to really have a tough time hiking rates into a decelerating GDP, a decelerating core PCE. Yes, the core PCE is still above target, but if we maintain under that 0, it should come down towards that 2%. The 25 basis points is very, there's a very real possibility that that 25 basis points is the last rate hike in this hiking cycle, barring any surprises. So if there's surprises, yes, of course, then there is potential for more movement. But the at the moment, the market is has discounted that 25 basis points, and we're seeing this drift. Okay, so we need to see some more economic data. We need to see a catalyst. Now, what's interesting here is that the RSI is to the bearish side of the oscillator on the US dollar. You bring up the Euro US dollar. Okay, the Euro US dollar, well, we're in zone 1. And what's very interesting about this is that there's a squeeze here as well. It's breaking through, it's starting to expand. The Bollinger is starting to pull away. It's in zone 1. Where is the RSI? Well, the RSI is on the bullish side of 50, and we're not overbought yet, right? Overbought for us is over 80. So it's moving nicely between 50 and 80 on the bullish side. So the Euro US dollar has an undertone of positive momentum. We go back to, and we're looking at the weekly basis now. So we're looking sort of longer term, right? We go through to the US dollar, and we've got this undertone of a bearish momentum. And that puts, I think, Euro US dollar on a watch list. Let's just go back to TradingView, do a little bit more analysis around the Euro US dollar. So we can see, just before we move on to the analysis with the Euro US dollar, we can see that there is a potential deceleration here in key economic data, and that's the GDP year on year, core PCE. Core PCE really a focal point. Inflation is being the real driver of Fed policy over the last year or so. Let's go to just a single screen, and let's take a look at Euro core inflation. Now you can see that the Euro core inflation is moving up. Remember, we were able to draw a downtrend line on the US core PC. We aren't able to do that with the Euro core inflation. And if you take a look at the rate of change, the rate of change is still on the acceleration side of 0. When we looked at the core PCE, it was on the deceleration side of of 0. Not so for Euro inflation. The Euro inflation is still problematic. Okay, whereas the US inflation looks, yes, it's above the 2% target, but it does look like there's been more progress in the fight against inflation. Not so when it comes to Europe. The ECB, I think, finds itself in a position where it has to be tough. It has to be aggressive. It's quite likely that we get a 50 basis point hike out of the ECB as opposed to a 25 basis point hike out of the Fed. Now, the way we're going to double check that is we're going to look at the 2-year yields, and we're going to measure the euro against that. So just bear with me a moment. Let's just bring that up. So we've got, I'm going to use the German 2-year yield as a proxy for ECB monetary policy, and I'm going to use the US 2-year yield as a proxy for Fed monetary policy, and we're going to look at the spread, the difference between the two yields. Okay, let's go through to a weekly here. What we can see here is that the spread is moving in that northeasterly direction. In other words, the 2-year yield of the German 2-year yield is pulling further away from the US 2-year yield, reflecting a more hawkish monetary policy. Let's just understand why I'm saying that. When we look at the yield curves, monetary policy influences the short end of the curve. So the 2-year is a very good note to use as a proxy for just how aggressive monetary policy, specifically when you're looking at spreads. And you can see that the spread here, certainly in favor of the ECB monetary policy. Why is that? It's because the shorter term rates react much quicker to the changes in the monetary policy. Let's add in the euro US dollar underneath that. Okay, and let's put in some peaks and troughs here. So we can put in a trough. So we're now starting to measure trend. I'm going to be, I'm not going to be too strict with the labeling. I just want to get the basic trend, the spirit of the trend. So if we put in the reference trough there and the reference peak over there, well, quite clearly, here is your higher trough. Here is your higher peak, and you can see that it is moving very much in a northeasterly direction, which is what we expect given the relative strength in the German 2-year. Let's make this black. We're going to do one more thing just to confirm the relationship here. We're going to introduce a correlation coefficient, and I'll take you guys through exactly what we're looking for in the correlation coefficient. A correlation coefficient measures the relationship between two instruments. So here we're looking at the correlation between the spread, and I'm going to put in here euro US dollar. And let's just put in the label here, so you guys can see that it's 79%. Let me just explain that to you. So I want everyone to understand just how useful a correlation coefficient is. Correlation coefficient has 3 levels that we need to pay attention to. Okay. You've got 1, which is effectively 100%, 0, and -1. If you've got 2 instruments that are registering as 1, then they're both moving lockstep. The one instrument is moving exactly the same as the other instrument. That would be a 100% correlation. If you've got a -1, they're moving exactly the same in terms of magnitude, just in opposite directions. That means they're perfectly inversely or negatively correlated. And 0 means there's no correlation at all. So what we're saying is we've got a 79%, 80% correlation between the monetary policy coming out of the ECB against the US monetary policy and the euro US dollar. So barring any surprises on the core PCE, barring any surprises on the US GDP, there is a certainly more aggressive ECB relative to the Fed, and that's reflected in the euro US dollar. Having said that, let's go now to the hourly chart of euro US dollar. And what we want to see is we want to just see the trend following indicator. I've got 2 EMAs. I've got a 5 EMA and I've got a 10 EMA. This is on the 1 hourly, and I've got the stochastic. Effectively, what we want to see is we want to see the stochastic moving up. We want to see the euro moving up. When we get these moving in the northeasterly direction, then of course we potentially have our triggers, and then we want to see the stochastic hang out above 80. Once we get that, we get a really nice swing. Now you can see that the euro US dollar had a really nice movement yesterday. I think that there's a dual analysis here. Go through to your US dollar, see if the US dollar is going to swing down. If the US dollar is going to swing down, so we look for the 2 crosses. Okay, go through to the euro US dollar and see if the euro US dollar is giving similar signals but in the opposite direction. And that would be very interesting in terms of an instrument to add to your watch list. All right, with that all said and done, if there's any questions, go ahead and type those in. Let me see what I've missed here. Look to the non-USD pairs. If US dollar is flat and volatility comes back, Anna's saying ECB officials warn interest rates could jump 50 points next week. Yeah, that makes sense. This would also, yes, that's exactly what we're saying, Anna. Recession potential to spread to Europe as well if more hawkish. Just unpack that for me, Gurdeep. In other words, the higher interest rates will impact on economic activity. There is a risk of that, but But you can see that the fight against inflation hasn't progressed nearly as well on the European side as it has on the US side. That kind of makes sense though, because the ECB started hiking rates much later than the Fed did, but it still has a serious fight on its hands. So the US dollar for me is always going to be the first link in that chain of causality. The US dollar, when that moves, it generally drives the market. You can look at non-US dollar pairs, which are, they're not majors, we call them minors, possibly exotics. They're much harder to trade. You can still look at the yield differentials, but the yield differentials, in my experience, work very well for the high liquidity pairs. So I tend to put an emphasis on the majors over the minors. Any other questions there? All right. What we'll do is we will wrap up here. Please join me tomorrow. Tomorrow we've got two webinars. We've got the morning market review and we have the crypto minute. Please join me for those tomorrow. Thank you very much for joining today. Guys, have a good day and a good evening ahead. Chat tomorrow.